Now, the 7 sins of fund management focuses on those self-imposed activities which broadly fail to add value to portfolio returns. Last week, we reviewed the first four sins, namely forecasting, the illusion of knowledge, meeting companies, and believing that you can outsmart everyone else. This week, we focus on sin number 5 to 7, short time horizons and overtrading, believing everything you read, and last but not least, group-based decisions. Welcome, gentlemen, to the program. Great to have you on. Adrian, let's start off with you. Short time horizons and overtrading, a sin that I know you're probably not guilty of. And we know that according to the paper, we've been seeing time horizons actually shorten over time. It seems that most people, and this is what James Montier alludes to, ADHD almost approaches to returns.
Yeah,
Let's start with you.
Well, I think that's a function of a range of factors, not just sins committed by fund managers themselves, but also caused by external factors such as industry pressure or client pressure, where people feel compelled to do something under certain circumstances, and often it's just for the sake of being seen to do something. But the point about short time horizons, well, there's ways in which you can measure this, and if the most obvious way is to go on a case-by-case basis and look at each portfolio and see what the average holding period is. But if you use entire markets, you do need to be cautious of making too much inference. But for entire markets, the average holding period for New York Stock Exchange is a year, for the London Stock Exchange it's for a year, and for the Johannesburg Stock Exchange a little longer than that, but hardly long-term investment periods.
And of course, in the 1950s, the time horizon, the holding period was around 8 years, so changing substantially. But then we've also seen the advent of traders coming to the market. So are you a trader or are you an investor? Isn't that then the fundamental difference, Kirby, that traders can't actually adhere to this rule in a sense?
Before I make a distinction between trading and fund management, I'd like to go back before the 1950s, and I want to bring John Maynard Keynes into the situation. You know, he's a hero of mine, and I think he knew a huge amount about investing, and he's often put on the back burner, so to speak, when you look at kind of the modern day gurus as far as investing is concerned. Look what he said back in the 40s. Investment based on genuine long-term expectation is so difficult today as to be scarcely practicable. I hope I've said that right. But in essence, what he's saying is that back in the 40s, already people didn't have a long-term time horizon. Now, with the advent of technology, with the advent of a lot more fund managers, with the advent of a whole bunch of new instruments, that time horizon, which in the 40s, I could promise you was probably at about a decade, has just become shorter and shorter and shorter. And quite frankly, in the active management space, there's a huge drive in order to try and make sure that your asset manager is doing something on a continuous basis so that at least they can earn their money. And this has got to do with these short-term time horizons. So yes, Eleni, answering your question, what's the difference between trading and asset management? Yes, there should be a huge difference, but sometimes they're not necessarily distinguishable, especially when you get to the smaller cap type companies on the JSE and you're focusing on those areas.
And of course, Roland, if you had to compare it to the actual 7 sins, it's regarded as avarice. So in other words, greed for material things in a very short space of time. And it's something that we all perhaps want. And this is why we are embarking on a different strategy. When you see investors coming to the fore, they're constantly re-rating and rebalancing their portfolios. Is that the right thing to do? Because things are naturally just speeding up. We can't avoid that speed.
You're right. There definitely is higher churn in portfolios, but I do think, and I might be a bit contrarian here, that there is good reason to rebalance more often. I think that at certain times when things change in the market, when risks get out of line, people do focus on the short term. In fact, at the moment, there's a lot of uncertainty and you're seeing a lot of volatility and a lot of trading going on because people are rebalancing their position. So if we can maybe separate, obviously there are long-term investors and those kind of investors that use fundamentals should stick to that kind of long-term view. But in the trading space, there are two types of traders. There's speculators, and then there are people who are trying to manage risk. And I do think that you cannot manage risk in the long run. You've got to manage risk over much shorter horizons. And I think that is what's contributing to a lot of this short-termism is actually people adjusting constantly to these changing market conditions.
Are you guilty?
I'm only guilty of chocolate ice cream.
And Kirby, I know that you also buy and hold for the long term.
Yeah, I mean, that's what we fundamentally believe in as a team, and that's what we try and do. But that comes with a caveat, obviously. We try and rebalance when we think the risk that is associated with being in a specific asset class is running very hard. We try and pull back on those if we can. And I suppose on a second level, the kind of things that we try and do is we try and be tactical about asset allocation, so that if we don't want to be in an asset class, we try and sell it.
Adrian, guilty or
Am I
not?
guilty? I'd like to say not guilty in any shape or form. The average holding period across our portfolios at Canon is just over 5 years at the moment. Some stocks have been there for longer than 10.
Wow, okay, definitely not guilty of that sin. What about number 6, believing everything you read, or sloth? It's a tough one because, there's a lot of information that comes our way.
There is tremendous value, I think, in gathering up this type of information. It goes back to a point that we were discussing last week, and that is that you get the case of information overload, where you're trying to analyze so many different pieces of information that it essentially just translates into noise. You want to be discerning, and you want to be able to separate out noise from true information.
The media is guilty here.
I actually wanted to allude to that point because it's really tough. Here we are actually looking at every piece of economic data that comes to the fore, looking at comments and, of course, making decisions or analysing movements on a day-to-day basis. So it's really hard to move away from that kind of
And I mean, the objectives are
trend
different.
that has been set.
The objectives are different for media, because I think the objective there is to sell a story, whereas the objective in fund management is to discern what is important and what's not important. Now, unfortunately, that doesn't often happen, or doesn't happen all the time. As a matter of fact, if you wanted to go and take any company out there, take Sasol, take Anglo, take an international company, if you try and read every single piece of information on that company that's either on a blog or on a website or released by the company, you're going to be busy a long time. And the question is, and that comes back to previous points we made last week, does it necessarily make you a better investor? Probably not.
Okay, and Roland, when you see that number 2, and I know that you weren't here for the first part of the program, but the illusion of knowledge, does this somehow tie in with thinking that knowledge actually puts you in better stead than others, and then also believing everything you read?
There are 2 types of knowledge: opinions and research. And I think a lot of focus in the industry, because people don't have the time, focuses on opinions. And opinions are notoriously dangerous. I mean, the fund management industry generally is riddled with these kind of heuristics, as people will call it. For example, when interest rates go down, markets go up. If you do the research, you'll find that actually doesn't happen that often. If commodities are a good inflation hedge, Sasol's correlated to the oil price. These are all things that you can test, and none of them actually are as true as we would like them to be.
So does that mean that you should be embarking on your own research? And we know that it really depends if you're on the buy or sell side of things.
Well, I'm biased. You need to be more quantitative than qualitative when it comes to these kinds of things.
I mean, that depends on what you're looking for. If you can understand what drives markets, and you can understand what factors and fundamentals drive markets, you can understand what you need to be looking for. But if you don't understand that, then how are you going to understand what drives markets? Then, literally, this is where what we call the growth story comes in. Where I come to you and I say, I have a fantastic company, I've got a fantastic buying opportunity. Why don't you all help and participate in this? And let me tell you how great it is. But it's not really based upon anything fundamental. It's really just based upon my opinion. And quite frankly, those stories sell in the market. I mean, that's what makes the market an interesting place.
I'll give you an example. I know that you guys focus on cyclically adjusted price to earnings. And a metric that isn't really widely used. So as a journalist, you read this piece of information and then you make an investment decision based on that piece of information. How would you then respond to what I've said to you? Because essentially I'd be believing what I'm reading with regards to what Canon Asset Managers is putting out there.
Yeah, I think that the point about not believing everything you read is, this doesn't mean that some of the things you read aren't going to be true. Of course, there will be some that carry tremendous weight, but rather that we try to consume so much and we often accept everything as gospel. There's a really great anecdote that comes out of a book written by Atul Gawande, who's a surgeon. And he says that the cure for many deaths, or the prevention rather, of many deaths going on in hospitals 100 years ago was right under doctors' noses, and it involved washing their hands. And they refused to look at that evidence right in front of them, and instead were searching far and wide for all types of explanations as to why patients were dying. And when this simple solution was put to them, wash your hands because you are the cause of death, many doctors refused to accept it.
That's quite a high point. I think we should leave believing everything you read or sloth there. Very high point, Adrian. And I think that you're probably not very guilty of this sin, right? So number 7, group-based decisions or wrath. Who would like to take this one on?
Okay, let me
This is
start.
tough because we know that teams are put together to make investment decisions or put portfolios together. How do you find a balance? Because you can't also just leave it up to one person.
I think Montier makes a critical point here. He says there's a difference between a statistical group and groupthink. A statistical group is where you take a whole bunch of opinions and where people are independently allowed to think about a specific topic and then come to and derive an answer, and you're taking the median answer. And that often has showed, if you look back in time, that those answers potentially could be better than only one individual with very limited time being able to come up with an answer. The problem with investment teams is that they don't do that. They sit at a morning meeting. I walk in as an example at a morning meeting, and I would sit down and I would say, okay, I think X, Y, and Z, and other people might think differently. Now, all of a sudden, you've got a human dynamic that you're trying to build within a team structure. There's a pecking order in an investment team as well. There's more junior people and there's more senior people. More junior people might really have something critical to say, whereas more senior people might have less to say. But you're too scared to say something. And I mean, I've seen it firsthand happen. I've looked at investment teams and I've analyzed investment teams for a long period of time. And you see it happening. The bigger the teams, the more marginalized the teams become, and the more what I call benchmark hugging they become. And then we have Roland's argument, which is why be active? Why not just be passive?
Roland, is that your argument?
Well, not necessarily in this case, but on the groupthink problem, you don't have that, right, when you're tracking an index. There's nobody thinking, right? Certainly, there are merits for active and passive. But coming back to the point of group behavior, there are actually books written about this, so there's a lot one can talk about here. But what they have found is that groups that are too small or too large are unproductive. And the number is about 5 to 6 people, apparently, is somehow optimal. Mike Morbison actually has done a lot of work into this. He heads up Legg Mason, and one of the things he does in the meetings that they have is he splits the team in half. And he says, today we're going to discuss this company or we're going to discuss this strategy, and half of the team has to take the opposing view. So he wants to have debate, fierce debate, rather than having certain personalities dominate the decision-making process, which often happens when you put groups
Don't you
together.
find, I mean, we also the herd mentality that if one senior person comes in with an idea and then the junior staff perhaps would be pushing for that idea, and then you sort of, it's self-fulfilling prophecy in a sense.
Yeah,
Adrian, is that what happens?
Exactly, and you start to become riddled with confirmation bias. You have people who are fearful of being voices of dissent or disagreement. So Roland actually cited the exact piece of research that I was going to suggest people look at, and that is Michael Mabuson's work on the effective functioning of committees. You want small teams, but on top of those teams being small, it's critical that you have dissent. You also want diversification.
How do you make sure within your teams that they're not embarking on this herd mentality and just following a specific path? What if someone came to you and said, we know that Naspers is looking expensive, but we think, Adrian, that we should add this to our portfolio. It's not a value stock, but what would you do if a different voice came to the fore?
I'd like to think that in the context of our business and our investment team, that we would encourage that debate, that we'd facilitate it, that you're not going to
Would you act on
shout it down. No, you're going to have debate. It's not a case of just acting on it, it's a case of debating it. And I think effective teams will have debate.
All right,
It's trying to, somebody did say this, I mean, it's trying to create an investment case. So, and if team members within an open structure can try and create an investment case for a specific holding, and there is a genuine investment case, it's that you're trying to get to come to the foreground. But when you're walking into a team and you say, look, the boss likes Anglo, better not say sell Anglo, or any stock for that matter, or Billiton, or Sasol, or Standard, it doesn't matter what the stock is. But if that's the case, then you have an unproductive investment team type environment.
Absolutely. Okay, so now we need to wrap up the 7 sins of fund management. What is your overall view, Kobe? Do you think that this report actually sums things up quite nicely?
Yes, I think so. And I think that investment teams would be well advised to kind of put these up as kind of the kind of things that you need to be thinking about, that you need to be trying to avoid, and you've got to be asking yourself the question on a continuous basis, are we doing this? Are we doing this? Because it's easy to fall in these traps, very, very easy.
Okay, Roland, are you buying into this report?
I think we're all fallible and we're all guilty of these sins to some extent. I think the way to try and minimize the effect is to actually focus on doing research rather than listening to people's opinions about most of the topics that we've discussed.